Hi everyone, this is Mehul Mehta and welcome back to my YouTube channel. So today we have a very special guest. We have Jacob. So just to introduce Jacob, so Jacob had almost a decade of experience in physics. So he was a physicist and then after that he moved to banking. So last 5 years he has spent in banking and of course he has brilliant. I'm not sure if you have read his LinkedIn post, but it's all amazing about IFRS 9. So today in today's session we'll learn about how to build credit risk models in IFRS 9. So first of all, before going into depth, thank you so much Jacob for doing this and thank you so much for coming to the podcast.
Any chance to get to talk IFRS 9 is very much welcome. It's always super interesting, and thank you so much for having me. And I think this talk will be a little bit of to give a little bit of sort of reflections. In Europe, IFRS 9 has existed since 2018. That means that a lot of sort of actual practice have developed around it. And my hope is to give a little bit of flavor sort of surrounding how we think about this, and also be able to give also sort of our perspective on the standard. And I actually start a little bit from a sort of historical perspective. And if we look back, I say a long time ago, but if you go back to IS 39, this was the previous standard. So it took a very long time, as you might see, to develop it, and then it was applied in 2005, right until the financial crisis. And the idea in IS 39, this sort of incurred loss model, is that as long as everything is normal, as long as the customer is paying you, you say, okay, I don't need to make any adjustments for credit losses. And in one perspective, and if you look at how many people without in banking see on things, I mean, that is a pretty reasonable view. You say, okay, but look, this is a paying customer. There shouldn't be a credit loss on a normal paying customer. And it's first when the customer trigger a default definition. So they really go, 90 days late or bankruptcy or something like that. That's the moment where you say, okay, no longer it's a good customer. Now we need to do start taking losses. It's important also, I think, to distinguish that strictly speaking, at this point, even if you've defaulted, you have not, strictly speaking, taking a sort of, let us call it, real loss. What I mean by that is that, at the end of the day, it's only when you write off the loan that you're sort of giving up and you say, okay, the loss is what it is. Because sometimes I think a very important misconception is that some people say, oh, IAS 39, then they looked at actual losses. And now in IFRS 9, as we will soon see, you look at, sort of forward looking. But even in IAS 39, you had an important model component, because if a customer default on you, you still, you might have some collateral, you might have some probability that they recover, and all of that you have to make models for. So also IAS 39 was a model-based standard, but it was much more restrictive on what you made models on. And it's also important to mention that if you have a portfolio that an economy that is in equilibrium, from a P&L perspective, not so much for capital, but from a P&L perspective, it doesn't really matter when you write things off, if you think about it. It's because I will have this sort of full credit cycle always on my book. So if I have a very early write down condition, that means that just, okay, I take the losses in the beginning, but then I don't take them sort of later. And if I, on the other hand, take them very late, I mean, that's where I take them. So it also means that this whole standard on, especially when we focus on the P&L perspective, what it matters is when the book is not in equilibrium. In an equilibrium book, it doesn't really matter super much how you set the standard, but it do matter when things changes. And the reason is that if you look at the normal lending cycle, and here I've shown the sort of, the growth in the credit growth in orange and the loan loss provision, so in the old IAS 39 standard. And what you see here is, since IAS 39 is then, of course, very heavily tied to the default rate, what you see was that for a long period, we had low default rate, high growth of the credit. And then you got the financial crisis and everything sort of swapped around. And then afterwards, you sort of reverted to a calmer period. And this was really where they got a lot of attention on that the standard wasn't really working. The IAS 39 standard wasn't really working as well as people had hoped, because there was this argument that you risk making things very sort of cyclical, that, sort of you take no losses, and then you have to take huge losses right at the sort of worst possible time. So you deteriorate your sort of, your capital buffers and everything has to start deteriorating right at the worst possible time. And this spread, all over the world when we had the financial crisis, and this became a little bit of the impetus to move on and say, okay, we have to do something about this. We need a new standard. So as we said, during the financial crisis, the problem was that if you wanted to invest in a bank, at the end of the day, what is it that you need to know? Well, you want to know how much of the loans have already gone bad, and you want to know what are the losses that can be expected based on future forecasts. I mean, nobody sits with a crystal ball, but if I have seen, if in the current conditions, if I've seen so and so many loans default, and I know that I have loans of similar quality, it's interesting then to understand, okay, just if current condition stays or it does as forecasted, what will the losses be? And remember, in the old IAS 39 standard, there was no indication of this, because as long as the customer didn't default, you would not reflect anything of this in the lending standard. And that meant that you would only learn what has already gone really bad, but you don't get any of this sort of forward-looking information. And the outreach that ISAB, the committee that then the international accounting standard boards that decide over the standard, show that a lot of people that invested in banks had to sit and basically do all sort of adjustments and figure out how many loans are about to go bad, how have credit quality deteriorated. And they pointed out that what we want is not for the analysts to sit and do that. We want the banks to do this analysis, and then we want the analysis to have an opinion on the bank's analysis instead. So a solution then that was floated was that you say, okay, I would like things to be more forward-looking. If you want to basically reflect the most up-to-date changes, why not use mark-to-market on it? So full fair value accounting. And that would mean that any changes in the market conditions would be included in each reporting period. However, there was also a lot of problem when there was discussed this in 2007, 2008, because one of the problems is, of course, that it's very hard to set these sort of, you can't really set, fair value prices based on a market, because a market might not exist. And there was even the case that, you had a lot of companies that actually had a lot of assets at fair value accounting that actually had to take them back to some sort of cost accounting because they couldn't really figure it out because the market was so crazy. And it also, one of the risks, and I often, when I discuss internally, these sort of questions, one of the things I push at is, the risk putting the questions on the wrong places. So if you would do fair value accounting, if you think about what questions you're answering, you're really answering, if I were to go and liquidate the company and try to sell off my portfolios, what would I be able to sell them for? So if you if you run the business on a fair value accounting basis, that basically means that you each month sit and think about this question: what can I sell the portfolio for? That does not really make sense if you run a business where you have really long-term loans on your books. I mean, if I look at my current bank, for example, not the goal is that customers should never leave us. I mean, that is, we are a partner to the customer. So then it becomes really weird that, the whole business line is thinking about how to preserve the customer. And then you would sit from the credit risk side and say, okay, let's calculate on selling that portfolio. And you would do that on a routine basis. You risk getting this mismatch between what the business is thinking and what you really want to do. And similarly, you would also get all sort of noise into the numbers. I mean, if, for example, interest rate changes, that's not really a credit risk. But that if you have fixed rate lending agreements, those changes in values when the rate changes, because if you were to go out and sell fixed rate loans and you're in a higher rate environment, the value will be less. But that's also not something we want to reflect in a credit risk measure. And also the fact that it is notoriously hard to calculate these sort of things. So basically, there is some logic in fair value. Fair value has some stuff that we want. A good example is that, let's say that you have a classical bond portfolio like corporate bonds, and the corporation that you have lent to, that now they go through a credit deterioration, they might be downrated and so on. Your bond is going to lose value. Because basically, if you want to sell it, people are going to be prepared to pay less for it. That's really the sort of forward-looking effect we're looking for. That's really interesting. But the whole fair value thing contains so many other things that we're not really interested in. So the idea was to say, okay, can we isolate, the part of fair value that comes from credit quality alone? And that would also allow us to focus on recoverability. What do we expect to not collect, which is after all what we're interested in. So the G20, so the 20 largest countries in the world, they met and they discussed sort of, how do you set up this sort of standard? And they said that, the old standard, to have no losses was too little, and then all the losses came too late. And they wanted this timeliness, this sort of, fair value part of the credit losses. And since it's a fair value part, it would also automatically be forward-looking, because similar to if you have a bond or a stock, I mean, you often say, it trades on the future. And that should then provide you with relevant information. Possible, you wanted to be able to compare between companies, faithfully represent the economic reality. There should be a simple sort of interpretation of the numbers to make them understandable, and be able to verify the calculations. So the first idea that was tested out, and I will show a little bit why I'm talking about this, is that they tried to build what's called a discounted cash flow model. So the idea is that what you basically look at is you say, okay, what cash flows do I expect to get? And that's, all the behavioral cash flows, both the income, but I also subtract the losses. And I then say, okay, if I have, the balance I hand out, and I now say what discount rate discounts this back. I mean, this is very classical to how we look when we value stocks and when we value other assets and so on. So the steps required was basically that, what you would be you would basically set the fair value equal to sort of the balance of the loan, typically, because that's really market tested. I mean, you have two market participants that are prepared to do this transaction. You did all the future cash flows to forecast them and put them in the cash flow place, and then you calculated this sort of discount rate. And this was then called the credit adjusted effective interest rate. And this would have been a good method. The problem is, however, that since you have to forecast the cash flows, you would have to bring in both the credit losses and all the income in the same calculation. And the banking industry complained a lot and said that this is sort of too complex. I mean, I would have personally probably argued that this is a very sensible thing to do, but the banking industry really complained here, because their argument was that we have these things in separate systems. In one system, you have the income, and in one system, you have the credit risk. And these two doesn't talk to each other, and that's why we really can't go down this route. And as we said, that meant that this solution didn't really fly. So when they then ISB tried to think about a little bit, okay, can we understand an alternative? And the logic they thought about is that, as I said, this discounted cash flow model, I mean, it's very used for example, how you value stocks. You look at what sort of for example, dividends you will get from a stock, and then you discount them back. And they said, in what way is a loan different from for example, a stock or a similar asset? And they said the big difference is the fact that loans is an instrument with a huge downside and very limited upside, if you think about it. So, yeah, as we discussed, I mean, in a loan instrument, you have a downside because if people doesn't pay you, I mean, you lose all of the principal. But if a company performs well and pay you, or the borrower pays you as they should, you only have a capped upside. So a good example is if you lend to corporations. If the corporations do well, they will pay you. If they do even better, they're not going to pay you more. You have capped your upside, and this is what makes loan instruments special. That you have the downside risk, but you don't have all the upside rewards, and that's really a lot of market participants said, that should be reflected in also how we account for these loans. So there is actually a good exception to this that really illustrates the principle quite nicely, because there's one type of loans where you really have a large upside, and that is if you buy distressed debt. So if you have, for example, a loan to if you not if you originate it, but if you sell distressed debt onto, for example, a debt collector or to another bank, that bank typically buys it at a massive premium. Out in Europe, for example, it's quite common that you would sell distressed debt for around 10% of nominal amount, and a debt collector might be able to collect around 20%. So from their perspective, they actually have quite a limited downside in the sense that they only paid a small amount of the nominal, but they have a large upside in the sense that in the best of worlds, if all of these distressed customers became performing, they would have a huge gain. Most of the time that would not happen, but they also limited their downside, because even if all the customers are unable to pay, they can only lose the 10% they paid. And for this reason, the DCF model I showed previously is used. It's called a purchase or origination of credit impaired, so POCI method. And it's used there, but it's not used for the rest of the standard, because most loans we expect the credit quality to be good, and this is why we have this capped upside and very large downside. And that's also the thing with debt, that it makes very sort of predictable payment, even as we have talked about. And this is sort of, the reason I've talked about this is the origin to why you get this SPPI test, the so-called solely payment of principal and interest. And that is the only type of instrument where we will do this IFRS 9 calculation that doesn't go through fair value, is this simple debt instruments with this sort of capped upside, very predictable cash flows. Because sometimes people say, okay, why do you only do why do you need the SPPI test? This is the reason. It's because it's a very special type of asset with very special properties. And that's why we say for everything else, fair value. But for these very special ones, we want there to be special properties. And as we said, otherwise we go through fair value accounting. I have two examples of the SPPI that I can just mention sort of shortly. I mean, one is that you have, for example, if you have a bond and the coupons are linked with the inflation rate, then the typical argument is that you pass the SPPI test because it's inflation adjusted, can be seen as a compensation for the time value. And another example, which you sometimes see, is that what if you have, for example, a mortgage in which payment depends on the income of the borrowers? Maybe not that so common to see with a mortgage, but in US, for example, you can have loans where, for example, student loans can sometimes be linked to your income. And that actually fails the SPPI test, because if you think about it, if you lend to someone and say, I will take a certain percentage of your income, you now have a very clear both sort of upside and downside in a product. It's almost more like you bought a stock in that person than it's really a loan. So in this case, it fails the SPPI test. So now when we have the SPPI in the back of the mind, we have this, that we want to make this sort of, there should be a capped upside, and then we want to look separately at the downside. And then the idea was to make this sort of two-step process. And the idea is that you make one step where you say, I will only now include contractual cash flows. So not all of the cash flows, but only the contractual ones. So if, for example, losses and everything is ignored, I basically do calculations on the instrument as if it's totally risk-free. And I will use that to determine the effective interest rate. And the advantage here is that, notice now that this can be calculated in your accounting system sort of separately. You don't need any input now from the credit risk system, as was a previous problem. And also, if you were over the lifetime, the behavioral assumptions were to change, you would then run those changes through the P&L. And now you do a separate calculation where you say, okay, now I have the effective interest rate, that's set. Now I take that effective interest rate, I take my projection of losses that I made, the expected losses over each period in time, and I will discount all of those losses back to now, and that will give me the ECL. And from a pure accounting perspective, this is really what the ECL is. We will soon see, that you guys will recognize, the PDD, the LGD formula. But I often find it's very instructive to start here to understand that, this is what we are supposed to do. We're supposed to estimate the losses per unit time, discount them back using the effective interest rate, and that's the ECL that we have to deal with. And then in the end, you take sort of, the gross carry amount, what basically to start with the balance that you handed out to the customer, and then you subtract off the credit losses. And I mean, one very nice way to interpret ECL is that you can basically see it, this sort of little, loss reserve that you set aside, And you can almost think about it quite similar to sort of, a provision for future liability. I mean, what you're saying is that certain of my customers, they will not be able to pay. So I set basically money aside for that, similar to how I would do if I had, some legal battle or some, other sort of future liabilities that I know I cannot really avoid. And you can then see it as this, little reserve account is really sort of invested in the same asset, so it grows with the effective interest rate. And that gives rise to this thinking about loan loss provisions. And another way to see it is that you basically can view it as you are measuring, your risky asset at an equivalent risk-free amount. So you give out a risk-free asset, let's say 100 units of it, and basically what you do is you say, okay, if this was a risk-free asset, how much would I have given out? Then I maybe have given out 90 units only. So I have sort of 10 units of risk in it. And you then basically look at the ECL as a sort of credit fee that you pay for acquiring such an asset. This is the reason we sometimes hear the concept cost of risk, because it's basically the ECL is sort of the cost of taking on this sort of risk on our book. And this a little bit also inverts the classical model. I mean, so in the incurred model, you would have that you first got all the income. If you think about it, you would get all the interest income, the customer would stop paying you, and now you would take the losses. In a forward-looking model, you a little bit reverse it, because you take an upfront payment basically, and or an upfront loss, and then you get the income afterwards. So you reverse this sort of logic. So now we have talked, we have set up a little bit of the stage here together. The goal now is to talk about the impairment. So if we move into the model, and we try to describe, how to compute it. So the goal here is that we want to calculate, we want to forecast these losses. However, most of the, if we just in theory, and sometimes I even see, people arguing this, that, this is what we should do, disregard all this PD and ELGD, that's some legacy nonsense. Just, put some AI and forecast these losses. But if we take a step back, for there to be a loss, the customer really needs to stop paying you. I think that's quite essential. I think there are some cases where you could have losses also, where you modify the loan and so on, but a little bit, I would argue, on a special case, and that they typically go through a sort of their own pipeline. But typically, to take a credit loss, customer need to stop paying you. So basically, you don't really need to model losses on. I mean, when you think about losses, it becomes very weird to think about, every single customer has a loss, because most of your customer will never have a loss in reality. It's only a small group of customers where you will take losses, typically, if you have good credit standards. And it's on that group that you should sort of zero in. And what you basically want to do is you would want to break up this loss number into, say, okay, is there a risk that the customer will get into trouble? And if they get into trouble, how bad of a problem will it be? And the idea that we are about to come to in this, the PD and the LGD model, is that allows you to make that separation in a very natural way. And that will also allow you to better, align your work with how the internal risk management works. Because if you think about how a typical bank works with its credit risk management, is that you have sort of two modes of operation. I mean, you have your good book where people are paying, and there you sort of monitor it and see, are there any signs there could be any trouble in the future? But, basically it's sort of more of you just being sort of a little bit of the passive observer. And then you have the book of, basically the bad book. I mean, the book where there are trouble, and there you go in and make very active actions in order to get recovers and to collect on and to get customers back and to work with them. And it's also very nice then that, if I just show the sum, I say, I took all the losses and I discounted back. It doesn't really give the business anything to work with. But we want to now break the model into such a way that the business can understand what we're doing, because that's always where we should start. So one very convenient concept that has then been introduced to work with this is the concept of default. So the point is that default basically allows you to say, which are my problem customers? I talked about this, a good book and a bad book. And we often use the term a performing or non-performing loans. And the idea is that you want to have this divider between what's a good and what's a bad loan. And that we call the concept of default. And basically, it means a customer that's so delinquent, because, if you're 1 day delinquent, I mean, that might be just by sort of, some problem with payment system, all sort of things. But if you're a customer that's really delinquent, and you've tried contacting them and there's no response, or they don't want to communicate with you, or they tell you that they cannot pay you, I mean, there is a problem. And there is something that you will have to deal with in this context and do something with. And you can then say that this probably is an inexpression of an inability or unwillingness to pay. And institutions have some freedom in how they set this up, but you have a number of rules. For example, here in Europe, EBA have set sort of the European Banking Association or Authority have set up pretty sort of strong guidelines around how you should set this up. I mean, the classical case we all know is that you have a backstop at 90 DPD. So if the customer is 90 days late, you should presume that they are default. But you're also expected to only treat this as a backstop. You are really expected to go early on and say, okay, do I see signs of severe issues? When it comes to corporate lending, a really good example is bankruptcy. I mean, let's say a customer pays you, and then the day after they announce a bankruptcy. Sure, I mean, they aren't due to pay you for another 3 months, let's say, on a bond. And then you can wait 90 days. So in theory, it could have taken you, 6 months until you set them in default. But day one, when you see the bankruptcy note from them, that, there's not going to come any money in 6 months. I mean, we need to take actions now. We need to be there, among all the other lenders to secure our piece. Then you also need to set them in default, because that you have to switch from, I'm the passive observer, what's going on, to full recovery mode. And this is why we talk about 90 DPD as a backstop. Similar, sometimes because you mentioned, I often write on LinkedIn on different topics, and this is one of the topics I often write about. And sometimes people say, no, but should I not be able to rebut this 90 DPD? And sure, there are very specific cases. I mean, I once heard about a case, for example, in Saudi Arabia, where someone had lent to the government, and the government took 4 years of paying that. Should you then put the whole government in default? These are very sort of edge cases, but for most of your customers, you would expect, if you have not received payments for, let's say, 20, 30 days, most banks will reach out to their customers and say, well, what's going on? Is everything okay? Do we need to make some sort of plan? How we're going to work together? And in that sense, 90 days makes a lot of sense. And it also is a very well-regulated concept then within the capital regulation. And since IFRS 9, very importantly, require you to have alignment within internal risk management, I definitely recommend that you always try to align your regulatory capital definition for default with that of IFRS 9. I mean, it is a mess if you try to run an institution and you say, oh, the customer is default from a capital point of view, but it's actually performing from an IFRS 9 point of view, and then internal risk management has its own. You always should try to streamline this at the end of the day. That doesn't necessarily mean that default is a game over. And I think that's also an important thing to think about, that someone defaulting doesn't mean that it's over. You still have a pretty good chance that you could recover them back. You might also have strong collateral and so on. Especially cure rate is an important part in this to think about. So it's more that default should tell you there is a serious problem, but there could still be things that could be done. And this is then the idea why we do sort of probability of default forecast. Is basically that we try to calculate when do we think someone will default on their loan. So, and the very extreme example you can take is there can even be a country that can default. Here, when in this case, in 2022, Bloomberg announced their projections for default rates for countries. That was in 2021, and then in 2022 we had Sri Lanka that then actually defaulted, which was also one of the high cases that Bloomberg had flagged. So once we have thought about the PD side, we have basically said, okay, we have now figured out from the PD which customers, what is this bad book. Now we move on to say, okay, look, these customers went default on us. What is our exposure? That doesn't mean that when we say exposure that it's going to be the loss, but what's at stake now. If you haven't lent something, nothing is at stake. But if you have lent a lot, there is a lot of money outstanding that you now need to figure out how you need to get back. And you then need to start thinking about recovery ways and so on. I think a good example I often use to illustrate this was that when Russia invaded the Ukraine, a lot of European banks had lent a lot to Russian companies. And could they recover some of that money? Possibly. But from an exposure point of view, if you just take the snapshot, right now we lend out, if you take these banks, right now they have lent out this much money. This is the money that's now at stake. It's the exposure that's out there. And we call that the exposure at default. That is the second component in the model. And it basically represents, the maximum loss when no recoverability can be achieved. And then, to get this exposure, you also need to combine together different scenarios, because what you need to do is you need to say, okay, let's say that you have a customer, and let's say that they default on you next month or 2 months forward. They probably will not have paid you anymore because they already are in trouble. But let's say you have a customer that default on you 10 years from now. I mean, these two positions are going to be very different, because in the 10-year case, the customer will have paid you until that time quite a lot of money. So your exposure probably is much lower. So what you actually need to do is you need to look at, what is the probability that they default each month into the future, that's this little PT, and then you divide it by the lifetime PD. So that gives you the weight, basically. Okay, what proportion of the defaults take place each month into the future? And then you multiply that by the exposure you would have at that point in the future, and you will also have to discount it back. And sometimes people say, okay, why should you be discounting it? And my favorite example is if you take a bond, for example. So let's say that you have a perpetuity bond, and if you hand out, 100 to that bond, and it instantly defaults on you, okay, you've lost 100. So that was your exposure. But let's say that you hand out 100, and then the bond pays you for the coming, let's say 100 years or 200 years, and then they default on you. I mean, if you didn't discount, in both cases, the exposure was 100, because the principle of the bond always stayed the same. But I think we can all agree that, I'm not so concerned about, a loss I might take, down the road 200 years from now. That's much less economic loss in that. And this is the purpose of the discount factor, that it really tells me what is the sort of time value of money of this future loss. And then the final step we get to in these parameters is the concept of recovery. So we have now talked about if we think about, we need to recover on an exposure that came because of a default. And this is this concept of loss given default. It basically says, if there is a default and if there is now an exposure, there might be an amount that you will not be able to get back. That is your loss given default. And modeling LGD then basically focus on this sort of subset of accounts that default. So I often say this, that if you work in loss given default modeling, you're only working on bad customers. I mean, that's the only thing you're working with. You're working with customers when the worst thing happened, and now you need to understand what do the banks do. And I think this is the big strength of the model, is that we've talked about here, this sort of PD times EAD times LGD, and what's sometimes called the Basel risk parameters. Though it's important to notice that what we have in capital regulation, so in the IRB, it's sort of, it's the same letters here. That's why we sometimes call them the Basel risk parameters. But the meaning in an IFRS 9 context is different because we have slightly different rules on how they're calculated and set up and so on. But the ECL is the product of these three. And why I really love this model is because it shows these sort of different processes within the bank. You have the monitoring department. They think about the PD. You basically have, the amount that's remaining, the exposure, the EAD. You have the recovery operations. They think about the LGD. So you can also map these parameters to different parts of the operation, and it also gives you an advantage to sort of explain what's going on. And basically, the impairment was created for reporting, but it is really useful for management as well. And sometimes I show this sort of, representation of it, that you can say, so you put the PD on the x-axis and you put sort of, the EAD times LGD, so the loss. So, one way to think about it is to say, okay, if there is sort of very little PD and there's also very little loss, this is excellent. I mean, very perfect customers, this is your typical mortgage, very, very safe customers, and you have great collateral to protect you. So the loss will be very, very little. Then over here, I mean, this is basically you handing out, tons of money in an unsecured loan, like you have very high chance they're not going to pay you. And you also have almost no collateral or protection. And probably that, that might be outside of your risk tolerance. Here you might have the case where, you might give they might be very safe. You might lend, for example, to a government, but you actually have no recourse. Should they cancel payment on you, there's not really that much you can do. And these can be tricky. I mean, you say, okay, it's very, very rare that it will happen, but if it will happen, I have literally no protection. And finally, we took the example of a good mortgage down here. You gave a mortgage to a sort of good customer, both sort of, low PD and good collateral. If you give a mortgage to, your classical sort of subprime, where they have collateral, but you actually also think that it's pretty likely they might fail, this is your classical sort of subprime. And basically, as we said, from the Basel parameter, we derived the ECL. And as we said, these parameters, basically the reason why we even got these parameters this way was because they were used in the IRB method, but we who worked in IFRS 9 gave it its own interpretation to them. And it's also important that typically in an institution, if you are an IRB bank, you should always try to align these two ways of viewing. The parameters shouldn't be equal, but you should have similar drivers and you should have similar risk thinking. For example, typically you can have, if you have an IRB rating on a customer, that's typically a great input to your PD model. And it's also become industry practice to do, PD times EAD times LGD. So auditors de facto do require them to exist. So we will now move into sort of the second part here of the presentation, which is we will talk a little bit about how to do the modeling. Of course, we will be on a bit of a surface level. At some future point, I'd love to deep dive on all the ton of details, but there's so many models in this. But if you look at, for example, the PD, so pre-IFRS 9, most credit risk models focused on either underwriting or capital requirement. And that meant that they typically focused on some fixed window. So in, for example, IRB, you focus on a 12-month window. In underwriting, you often use something between 6, 12, 18 months of a window. But you have this very fixed thinking. You say, in 12 months or in 18 months, I go and I check the customer. Are they performing or non-performing? So it's a yes or no question. Your model is a very binary thing. This is the reason why logistic regression is so common in the modeling, because you're only asking a yes or no question, and logistic regression was built to handle yes or no. But IFRS 9 require you to have a different mentality because, as we saw before, you're working with discounting. You're trying to answer not only will the customer default, but you're trying to ask when will they default. And as we said before, if they default in 100 years from now, yeah, that's the same default as if they default one day from now. That's a lifetime default one in both cases, but the economic consequences are very, very different, and this we need to be able to reflect in the model. And hence, this is why we need to model the the probability at each time. Often you use months as a time scale, and you need to build a model for this. And that also then allows you to think about extrapolating long-term behavior. And it's also, and this is one of the things I often stress, it's really important to distinguish between, so when you do PD modeling, you're looking at what is the probability that they ever do a default. So that there is a default within the window, because sometimes you can have customers that default on you and then they bounce back and become performing again. And people might say, no, at the end of the window, they were all good customers, so there wasn't a default. But it's a very different thing. A customer that always pays is very, very different from a customer that went default and you were able to recover back. And you should really be able to distinguish between that within your model. And the solution to this is what we call a hazard model, which is I am myself incredibly fond of this way of modeling in IFRS 9. So the idea is that you move away from focusing probability and instead focus on the risk intensity, so the default risk per unit time. And since intensity is a strictly positive thing, we often use the logarithm, so we call it the log hazard, is what we model. So that means that the e to the power of z here, that is the hazard. But the advantage of using e to the power of z is that z can now be any positive or negative number. And you then integrate the risk, because that gives you how much risk have the customer been exposed to. And you then put it in this formula with the exponential, and to get the survival. And the derivation of this formula comes from the fact that you can sort of only default once. Similar to the latest James Bond movie, where they said, he said, only you can only die twice, but in this case it's sort of once. In the sense that sort of you said, okay, what is the chance to survive the first month, the second month, the third month, the fourth month, and that becomes a product, and you aggregate them together. And it's also quite of a nice scale. I mean, I often calculate these log hazards, and the nice part is that -10 on a log hazard scale means a PD of 45 basis points. That's a very safe customer, very nice. And the log hazard of 0 is a PD of 63%. That's a terrible customer. But it's a quite convenient scale to use internally, because between 45 basis points and 63%, if you plot it on a linear page, it's not going to work at all. But so it's also very nice sort of internally. And what you then tend to do is what's called a weight of evidence method, which is that you might have tons of different variables you want to model. And what you can do is that you can look at, first you can start with a sort of baseline profile and look at, how is the customer changing over time. So you typically have a loan cycle where, in the beginning you have quite few defaults because you should have given, only sort of customers that are good loans. And then over time, defaults tends to go up and stabilize at some stable level once the customer might have gone into more sort of riskier operations and so on. And then you take each sort of variable and you basically build a small model for each variable. Say, if I know this information, if I know information about the income, I know information about the age and so on, how should I change this baseline risk profile? If I know, for example, that this customer is a very young customer, what does that tell me about how the risk change? I should probably shift the risk upwards, because it's actually now probably a slightly riskier customer. We typically at least tend to see here in the Nordics. While you have, for example, a customer that's highly indebted, that also is probably a customer that should be shifted to be slightly riskier. Similar, classical cases, if you look at past delinquency, customers that in the past have been delinquent, this is an excellent indicator that there might be an issue in the future as well. So you basically build, you take one variable at a time, and you build this sort of weight of evidence, what we often call offset. And then what you do is, in the end, is that you combine them together into a sort of regression. And the idea here is that it's much easier to do this one variable at a time and then put them together in a regressor, rather than to run all the variables at the same time, because it's also much harder to analyze that sort of model. The nice part here is that you can look at each of the offsets at a time, you can talk with the business, you can talk internally, and then you combine them together. Similar, it's also important to do good sort of customer segregation. And there should also be a very active discussion on, at the end of the day, what you should be thinking about when you talk about segregation is, what features should be kept within the model and what features should be kept sort of, segmented. And what I mean by that is that, if you want to keep everything in one model, some of the customer's information should be relevant for the other customer's information as well. And I think one common, sort of split is delinquency. And what I mean by that is that if you have customers that never, ever been late, or they've been very long time since they were delinquent, there is very little information to go on from there. You will have to search otherwise. Well, if you have customers that, they are delinquent at the moment, in my experience, the only thing that matters is almost how delinquent are they, because if they are in a delinquency or how delinquent have they been in the past, they are in trouble. That's the delinquency information that matters. If they've been delinquent in the past, you look at that delinquency history. How deep did they go? How often did they go delinquent? And if you lack the delinquency information, you rather say, okay, I might have to look at credit scores. I might have to look at some other variables. And it's also very common to look at where you got the customer from, because different customer channels can actually have very, very different customer population. A good example here in Sweden is that we have a lot of loan brokers, and these loan brokers, they find customers in very different ways than our internal customers, and hence those populations are very different. And at the end of the day, you need to make reasonable splits because you don't have infinite amount of data, but you also don't want to cluster together groups that are too different. And one aspect that, especially if you are like I work for a very low risk bank, one aspect some people don't always think about is that there's not just one way to default. You can also do that. You undergo what's called attrition. So at the end of the day, the loan can expire because the lifetime is up. You can also have that they default on you, but they can also try it because they leave you as a customer. And you could even have the fact that the customer basically goes deceased, especially, as I say, in a low risk bank. The later part is not that uncommon. And it's important to think, especially attrition, it's important to think about because attrition really mitigates your credit risk. I mean, it's bad for the business, but if you have to calculate the provisions, you really need to account for the fact that customers are leaving you preemptively. And you also have sort of, a little bit of interaction between these. So what is common is that, that you can do a model where you model the default risk, but you also model the attrition risk. So what is the risk that, the customers are leaving because they go somewhere else or get some other offers? And if it's really important to segregate these effects, because otherwise it's very easy to think that the customer is really safe, but the only reason the customer looked safe was because they left you. So had the customer stayed on your book, you would have really had a big risk. And what's common is that if you then segment these, you say, okay, I have the attrition risk driver and I have the default risk driver. What's nice is if you build them, model them sort of separately and then combine it, is that you can then say, what if the customer cannot attrite? For example, what if credit market conditions change so that customer cannot sign on a new loan? How much of this latent risk will I have on my book? And that's typically called a competing risk model. So you now basically add on the thinking we had before, where you had the default hazard, but you now also have an attrition hazard and even a death hazard, because in these cases you have different outcomes, so you should also trace them separately. You typically also embed on forward-looking information. So one of the main critique was that IAS39 was too backward-looking, and what you often do is that if you only use sort of traditional, backward data, you get a very sort of static model. So you really should say, if I think my macroeconomic conditions are going to be changing, the model should be adjusted. And I often think there's a lot of hype around forward-looking information, but it's really not that weird when you think about it. If I had a certain period I got my data from, and that period had certain economic conditions, okay, if I think economic conditions are going to be different in the future, I need to adjust for that difference. If I only have data from a very sort of benign credit period, I need to adjust the fact for that the future could be not so benign. COVID was, for example, a good example where we did these sort of adjustments. And what's quite common is that you run either 3 or 5 different scenarios. So you run a baseline scenario, an upturn, a downturn scenario, and you might also run a severe upturn, a severe downturn scenario. And it's typically good to run them in pairs because you need to preserve the symmetry, because you have to have an unbiased view. But it's often good to do both a sort of a sort of downturn and a severe downturn, because you might have very different loss profile in a sort of mild downturn in a very severe downturn, especially if you have, for example, a lot of collateral that protects you, because the collateral might protect you in the downturn, because then the customer default, but you can, for example, sell the property if it's a mortgage. But in a very severe downturn, property prices might really take a dive, and then you're no longer protected, and that's really where you start taking the big losses. And it's common to then weight them together. I mean, the sort of, you see here sort of the version, sort of the in between. And this is a whole separate chapter, how you set the weights. I have a whole sort of different talks I've given from time to time on, how do you set this weighting and think about scenarios and so on, and how you sort of approximate them together. And finally, so we had this, you built this competing log hazard model. You sum together the defaults. If you look at the default rate here, you get how much was it that actually defaulted, and also you take a certain proportion of the deceased customers, because sometimes a deceased customer might mean that they almost act as like that attrition, but they just unwilling attrition. But sometimes you might have a customer that actually their estate cannot really pay, and a certain proportion of them needs to be included in the real default. And your cumulative PD is then you basically integrate this function. So you see in this framework, the 12-month, lifetime, all of it we can get in a unified framework, and we forecast this on each instrument. And then the exposure default, I mean, I will move that through pretty quickly, because for loans, what you typically do is that you basically forecast down, how will they pay down the loan, and for example, straight line or annuity, and then what you will do is basically just say, okay, I assume that 3 months before they default, I assume that they stop paying me. Now, sometimes you hear people discussing the concept of over amortization. So the fact that some customer will pay down their loan faster. So this is different from attrition. Attrition is that they close down their position, but in over amortization they pay you sort of more than they needed, but they still stay on the book. Do you need to worry about this? In practice, my experience is it's the risky customers that you need to worry about, and the risky customers are the ones that are least likely to be over amortizing. This is why, in my experience, this is not really that much of a concern. When it comes to cards, there is a little more of tricky, because for cards, customers can draw down on their credit line. So the majority of the customers are transactors. They have very little that the balance that actually runs an interest on it. They draw on the card, they pay back. They draw on the card, they pay back. And typically, sometimes customers go from being a transactor to revolver. They actually start not paying down the card fully, and they start putting on a balance. And that's really when you earn money on a credit card, to be honest. But that's also when the risk then goes up, because if they are actually not paying you down because they're unable to, that means that they might not really have that much cash flow going on. So if the cash flow position for them worsen even more, they might not be able to pay you at all. So then you need to be able, when you do the modeling on cards, you need to reflect both of these. You need to reflect this, that typically the customer will do some pay downs, and also the fact that a customer in distress might actually be drawing down on the card even more, so that they're actually pushing it upwards. And you then get this sort of joint model where you say that the EAD is you take the on balance and you say, okay, they probably were able to reduce the on balance a little bit. That's called the credit retention factor. So it's how much was left of the original current on balance. And then you have what's called the CCF, which is you take the off balance and say how much did they draw up on in distress. Sometimes you see that people set the CRF factor to 1. So it's just say EAD on balance plus CCF off balance. I often recommend against doing that sort of modeling, because it can be quite unstable, especially if customers actually default on more money than they had or if they default on less money than they had on the on balance, which happens from time to time, because then it would be like CCF was negative, which doesn't really make sense. The CCF needs to be between 0 and 1 to make sense. So we will move to the final component, which is the LGD. And it's basically to say, you're in default now, what are we going to do? The first thing is that, so these sort of credit impaired or non-performing assets, we will try to do recovery. And yeah, I should also mention one short caveat is, please be noticed that the EAD could be very different from contractual balance, because you might have acquired the loan at a premium or discount, or you might have different fees and so on that are put in, or origination fees that should be taken out. So please notice that you should be quite mindful on that difference. And you should also distinguish between the PD and LGD. Sometimes you hear people say things like, yeah, this customer, very low LGD because they're a very good customer. Yeah, but the LGD is only going to trigger if they default on you. So that means that all customers where you think about LGD are bad customers. So you have to think about a world where the company or the consumer failed on you, and now what you're going to do, which means that it's a very distinct way of thinking about the customer. And you then might do all sort of risk profiles on the LGD, on what sort of collateral is available, and that the mortgage is the classical example. And I will do a little bit of a simple LGD model to illustrate here, which is that typically when we have a customer that default, the first thing we do is we try to cure the customer back. I mean, you never want to go into formal recovery with a customer. You want them to get back on your book. I mean, they are your customer. They are the lifeblood of your business. And you call them, you talk to them, you say, can we work together? Can we put up a payment plan, payment holiday, loan modification? You have a whole arsenal you try to deploy to get them back. And that means that, but even if you manage to cure them, and this is a very important thing, sometimes you see people say, if we cure the customer, because even if they cure, this is now a high risk customer. This is a customer that might so we often call that number loss given cure. So you still need to basically take again in the future the sort of multiple default effect. This is where that comes in. So multiple defaults doesn't come in the PD model. It only comes in here in the model. Only happens to deal with the first default, and then debt collection. If no cure is possible, you move into the debt collection, and you might have all sort of ways how to do it. I mean, you might, for example, sell it, that you have, like, for example, what's called forward flows, where you agree on certain sale prices, and that's what you will be able to recover. And so the joint model, or if you have collateral, this is where the collateral come in. So sometimes you also see the term loss given loss for this loss given sale. So you will have that the LGD, if you cure, you get still this residual risk. And if they don't cure, you go into formal collection mode. And, that would have taken a whole separate talk to talk a little bit about, that sort of continued recovery. But that's basically what sits in that term. So it's almost like, these Russian babushka dolls that, you take smaller and smaller pieces and try to understand them. But that also gives you valuable information to the business. I often find it's really good to be out in the business and say, what's the cure rate, what's not the cure rate, and so on. Final thing I will just burn through very quickly is staging. And the reason staging came together was due to the matching principle, because the logic is that in accounting, expenses should be reported at the same time as revenue. And the incurred loss model, if you think about it, really violates this principle, because you take all the income revenues we talked about before, and you then only take the losses once they go bad. So you have income before the losses. This credit adjusted effective interest method that I showed, that would have worked, because there you would have had this matching where you gradually sort of change the value and you'd combine them. But the industry said that, this is too complex. The expected credit loss model, if you take the lifetime loss right away, would violate this principle, because you basically take all of the losses day one, and then you get the income. So it's now swapped the wrong way around. We have taken a sort of too extreme, too much, too early. And this is, in US, you do this, and they say, okay, let's live with this. You take this big day one loss, but ISAB wanted to be a more sort of nuanced approach. And basically what they said, okay, this can lead to very sort of weird sort of effects. One good example is that if you purchase a portfolio from another bank, you negotiate that loan with or that asset with them, and some of the asset quality might not be perfect, so you get a discount from them. So management are super happy, and they say, oh, look, we bought the portfolio had 1 billion of nominal, and we managed to buy it for 900 million. Great success. And then you come to them and say, oh, by the way, you have to book some credit losses. And they say, no, we got this discount of 100 million. That's only what we're going to book. And they say, no, the standard require you to book a credit loss as an additional loss on it. And it's something very hard to explain. The phenomenon is because we view these always as sort of new loans. That's why you get this day one ECL. And ICB wanted to reduce that effect. And basically what they introduced was the concept of staging. But yeah, as I said, nobody really was happy. This didn't really help that much, because it became very complex. Because ICB's solution was to say, if the default risk has not really changed that much, you only need to recognize a portion of the losses. So the portion attributed to 12 months of default, and that's called stage one. And the idea is that if when you originate a loan, you are protected by the fact that you that can charge an interest commensurate to the risk of the customer. So risky customers get high interest rates, safe customers get low interest rates. So you have already protected yourself against the expected losses, and hence, this is sort of, similar to this sort of hybrid thinking that we saw in this DCL model, and there's no real economic loss. But if the accounts show a significant increase in the default risk, you're no longer protected. I mean, you cannot go and increase the customer's rate. Ergo, you are now taking the full sort of economic loss, and this is why you should move to lifetime losses. And then if they go default, you move to stage 3. But the problem is that nobody really knows what stage 3, how to move between stage 1 and stage 2 and how to set that. We have two boundaries to work with. If you're investment grade, you have not significantly increased. And if you're 30 DPD late, then you should definitely be in stage 2. But in between there is a haze. I mean, I worked for 3 different banks. All of them have done different things. When I talk to a lot of people in the industry, nobody seems to know. We often say the quickest way to figure out that someone isn't understanding IFRS 9 is that they say, no, we know how to do staging. So this is, without a doubt, the most technical part of the standard. And in practice, you tend to do all sorts of regulations that, you use the backstop. You typically try to identify it before delinquency. And what you tend to have is some sort of minimal PD. You tend to look at relative change, absolute change, and also do some sort of, forecasting and similar. And ISAB did a review. I have actually changed the note, but they did a review last year, and they basically conclude that they're not going to make any change. So unfortunately, we will not get any more guidance on this. So with this, I sort of summarize and say, we've looked at, the concept of simple depth instrument of the book value minus ECL. We've looked at the PD, the LGD model, how to calculate it, and we've looked how to adjust the different parameters using forward-looking information. So yeah, that was the really sort of, speed version of IFRS 9. There's so much more to talk about, but I hope this sort of covers what could be of interest here.
So thanks, Jacob. Thanks for doing this. I mean, lot of things actually I also got to know. So really appreciate your time and really thank you for joining in. I believe if I get a lot of questions, from my
Very
followers.
feel free to reach
Yeah.
out. I mean, and if someone wants to add me on LinkedIn and talk IFRS 9, feel free to do so. I mean, I really love talking about IFRS 9, and I also say my one advice I always give. Sometimes people ask me, oh, how do you learn IFRS 9? Because as you mentioned before, I have not really been in the area that long. But I say where I really learned a lot was working with a lot of practical cases and hearing other cases. I mean, for example, I was once listening to an Indian presentation where they talked about LGD of lending to cattle, which is a really fascinating topic. I mean, if you think about it, someone borrow money, they buy cattle, and you have the cattle as collateral. But the thing they pointed out is that if the farmer fails on the loan, typically he might not have fed the cattle, he might not have taken care of it, they might have diseases. So the LGD becomes higher because the cattle now can be sick and not taken well care of. And that's easy to forget. You say, oh, I have this nice collateral because I have this valuable cattle. But of course, their quality depends on if they're taken care of. And if you now condition on default, that's typically when the farmer is in a bad position, then he probably did not take care of them. So there are so many really interesting examples which really sort of, teach you a lot about how to perform the standard.
And I feel like every bank has like different, they try to model things differently because I have spoken to a lot of people regarding IFRS 9, and I kind of try to see different things coming along, maybe because, yeah, every, like different, because like different modeler has different, style of modeling. So, yeah.
Yeah, but at the end of the day, what always you should think about as a modeler is you should try to have as much connection to the business as possible, and make sure. And I hope I have given a little bit that sort of thinking that we always, because it's very easy to get stuck in all the math and beautiful form. But at the end of the day, we need to understand the underlying business, and we need to understand, how are it connected, and make sure that the business processes connect back to this, because this is how we make good analysis that makes sense to investors, but also makes sense internally in the organization, and get into this loop where management really cares about the numbers and they care about knowing the PD and the EAD and the LGD. That will only happen if it really represents business reality.
Right, right, right. No, but really, this is like something which is very fundamental, right? I mean, so yeah, mod does actually talk to a lot of business stakeholder, but they should also know how to, connect things. So yeah, definitely like great presentation and really loved it. Loved the presentation.
Yeah, but thank you so much, and love being here. Then I guess all I can say is wish you and all of you have listened a very nice day, and looking forward to keep the IFRS 9 discussion going.
Perfect. Thank you so much.
Wish you a very nice day.